Hi, my name is Darren Joseph from HED Tax, and today I want to talk about permanent establishment and protective returns for foreign companies doing business in the US. Generally speaking, foreign persons, whether they be natural persons or human being or a legal person, will be subject to tax only on their US source income. This can arise under two general scenarios. The first scenario is this. If you, as that non-US person, engage in some sort of business activity with the US, if you reside in a treaty jurisdiction, so a jurisdiction in which there's a double tax agreement, for example, the UK or Portugal or Spain. Generally speaking, the resident of a treaty jurisdiction would only be subject to US tax on the US profits if there is what is called a permanent establishment or PE in the US. What does PE mean? What does permanent establishment mean? Although income tax treaties can be nuanced and they can have some slight variations in the definition, generally speaking, a permanent establishment is where the business in the treaty jurisdiction, for example, UK or Portugal or Spain, has a fixed place of business in the US, such as an office, a branch, a place of management, a factory, something of that nature. The way I like to put it is if you have boots on the ground in the US. So the second scenario is where you, as the non-US business owner or business, reside in a non-treaty jurisdiction. So this is a jurisdiction that does not have a double tax agreement with the US. So for us, that's commonly someone who's in the UAE, especially Dubai, or in Singapore, where we're based. In the absence of a double tax treaty, that foreign taxpayers' federal income tax exposure is limited to what is prescribed in the Internal Revenue Code. And as before, only the US source income is potentially exposed to US income taxes. So clearly, this whole discussion around that US effectively connected income, whether there's permanent establishment, etc., can be quite nuanced. You need to seek advice. Note that under Reg Section 1.882-4A36, foreign corporations with limited activities in the US that determine that these activities do not give rise to effectively connected income may still file a tax return for the tax year. Why, you may ask? This is to protect their rights to receive the benefit of deductions and credits in the event that it is later determined after the return is filed that the initial determination was incorrect and tax return was indeed due and taxes were payable for income that arose from the US. So this is the notion of what we call a protective return. Note that the initial protective return does not need to report any income as effectively connected income or report deductions or credits, but should include a statement that the return is being filed to preserve the foreign corporation's right to deductions and credits.